Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning, hello and welcome to Bazaar Trading Call. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. It is the 4th of July and perhaps in some ways the US president couldn't have asked for more because, it's almost a perfect backdrop for the US market. Is that going to give enough ammunition to the bulls here back home to get their mojo back or not? We'll discuss this, all the cues and news that matter along the way. I'm Surabhi Upadhyay, with me Mangla Malu and Rima Tendulkar. Hi guys, morning.
Hi, 4th of July, and for the US, fresh highs on the S&P, NASDAQ, and that big, bold, beautiful bill is soon going to become a law. But back home, just looking at Asia, there appears to be a little bit of caution.
Well, there is a little bit of caution. We'll see where that goes. And yesterday, we saw that last hour decline on account of expiry. The question is whether that gets adjusted today in the first hour or not. But speaking about the first hour and last hour, I'm looking at the test match.
I knew you'd say that. I was wondering, no, you were not looking at US markets.
I was looking at the US markets, but then they were doing what they were doing, right? You watch the Indian markets, you watch the Indian batters, 259 for Shubman Gill and then Akashdeep coming in, taking quick wickets. We're poised for a good game. Let's see where that goes for both markets and the Indian Test cricket. So far, so good.
Good feeling this Friday. We'd perhaps say that. So let's get started and tell you about all the key cues. So like we're saying, the big headline is the big, beautiful bill, but I'll come to that a little later because the trigger for the market, which shut a little early for the 4th of July holiday anyway, was the fact that the jobs report is way better than expectation. And that's what led to record highs for these two indices, the S&P 500 and the NASDAQ, once again galloping along. So we've got about a gain of, almost 1% on the key US indices. Coming to non-farm payrolls now, the estimate was 110,000. The actual number came in even higher than the May number at 147,000. So looking very good. The unemployment rate actually ticked down as well from 4.2 to 4.1%. Now, as a result of this, equity market surged, but there was some unease in the bond market. Yields marched higher, almost 5 basis points higher on the 10-year, almost 9-10 basis points higher on the 2-year. Because with this kind of a jobs report, the market is now scaling back its expectations of a Fed rate cut, at least in this meeting, in the July meeting. If you look at the CME Fed Watch tool, then it's suggesting that there is a 95% probability now that the Fed is going to stay pat on interest rates. So that's what the big headline was. In fact, this jobs report also pulled up the dollar. The dollar index in intraday action had hit, a level as high as 97.20 thereabouts. This morning, let's see where it is. It's still above 97. So pullback happening on the US dollar as well. Now let's talk about this big, beautiful bill. It has become a reality, and that's what, the US president wanted. He wanted to sign that into law on the 4th of July, on Independence Day, and that's what will happen now. The passing majority was fairly narrow, must point that out as well. It was 218 votes in favor and 214 against. 2 Republicans voted against the bill as well. So it was not without its share of political drama. We know it's going to add about $3.3 trillion to the US budget deficit. And there are big sort of tax cuts, tax extensions, big deductions as well, and the very contentious, clawback from the tax credits that EVs were getting. That was, of course, the big talking point as well. So that's the big, beautiful bill. The other positive news came in the form of Apple. Just giving you a sense that corporate America is chugging along. Apple finally saw its China iPhone sales rise by about 8%. And it's the first time that this has happened in the June quarter in the last 2 years. So if you're looking for more incremental positives, there were plenty in US market action yesterday. So all in all, looking pretty good. Now, will all of this translate into buoyancy for our market? That's the question, because global cues have been actually fairly all right through the week. Yet we've spent the entire week in consolidation. The Nifty has been a very tight, trading band of about 250 basis points. We're at the lower end of that trading band as we speak. The upper end is, of course, 25,650 thereabouts. So can we get back to the highs, at least, of the trading range today? Let's see. We'll find out. Going forward over the next couple of days, I just want to highlight a couple of events that will drive market action. Maybe it's the calm before the storm, you can say. And why do I say storm? There's earnings season coming up. Obviously, clarity on overall global US tariffs beyond Vietnam, clarity on the India-US trade agreement as well. And let's not forget the GST meeting is going to take place in July as well. And that perhaps is a big event that markets will watch out in case there are meaningful changes in the slabs themselves. I want to just end with a lookout to defense stocks. Watch for all of these because yesterday the Defence Acquisition Council again approved proposals worth a massive over 1 lakh crore rupees is what we're talking about. So maybe some of the stocks will perk up. They took a bit of a breather. So watch for this. Momentum is anyway on the side of the defence names. And they're looking at procurement of all kinds of systems and armoured recovery vehicles, electronic warfare systems, surface-to-air missiles. So the whole gamut. So watch for defence, perhaps an interesting area to observe today. Rima.
Indeed. So take note of the defense news and the stock price action today. But the action is warming up, right, in individual stocks and stories. But quickly, let's pull up Asia because the Korean markets and the Hong Kong markets, that's Hang Seng and Kospi, both of them are down nearly 1.5% as we speak right now. And there are cuts even in the others. The Taiwanese markets is down more than 0.5%, and Nikkei too has a red tick. The GIFT Nifty for now is on the flattish side, but this whole week, markets have been extremely range-bound but resilient. The Nifty is down about 0.9% week to date, but mid-caps managed to buck the trend with a gain of close to about 0.5%, and we've oscillated. The Nifty at least has oscillated in a very tight band. So on the way up, it's the Monday's intraday high of 25,670, and on the way down, it's that 25,378, which was the intraday low, and it pretty much ties in with some of the moving averages. The 10-day simple and the 10-day exponential moving average is at that 25,350 mark. In terms of flows, the DIIs bought 1,333 crore in the cash market. The FIs net sold nearly 1,500 crore. They've been selling through this week. In terms of individual stocks, it's Marico. We'll discuss all of these in greater details, but just to quickly put the snapshot, the India volumes have hit a multi-quarter high, revenue growth in low 20s. Bank, some of the updates have been a bit disappointing. So for Bank of Baroda, the loan growth and the deposit growth has declined on a quarter-on-quarter basis. Bandhan Bank, again, the loan growth has fallen 2.5% quarter-on-quarter. RBL Bank, Yes Bank, again, the updates from some of the banks have been on the weaker side, but NBFC updates have been encouraging. So Bajaj Finance, for instance, has reported an AUM growth of about 24%, and L&T Finance too is ahead of expectations. So action is warming up over here. It's a Friday. The trading week is drawing to a close. Mangalam, what are you looking at?
Well, I feel a lot better in today's trading session than what one would say in the last hour of yesterday's trading session. And the reason why I say that is because yesterday's last hour decline seemed like it was largely on account of options expiry day. Why do I say that? You know, if you look at the intraday chart of the Nifty, the bulls were hoping for that 25,500 mark to hold. It wasn't holding for a while, and thereafter towards the last hour, we saw all those put writers run for cover and then throw in the towel. And if you look at not just the Nifty, the two biggest components of the Nifty, we had Reliance as well as HDFC Bank. Both of them saw a big decline only in the last hour, telling you that a large part of the last hour move was expiry related. Now, if you look at the GIFT Nifty is indicating a flattish start, the first thing we'll be looking at is will Reliance and HDFC Bank undo some of the big gash that we saw in the last hour of trade yesterday or not. And the other part is that the US markets, they're shut in today's trading session on account of the Independence Day, which implies that when the cat is away, the domestic mice play. We'll watch out for all those small and mid caps as well. But the FIs, they're selling in index futures, lock, stock and barrel. Yesterday, they sold about 2,400 crores, unwound about 6,000 longs, added about 6,800 shorts. And just to put things into perspective, over the last 3 trading sessions, the FII longs have dropped from 37% to 29%, and the net exposure on the short side has actually doubled from around 38,000 contracts to 62,000 contracts itself. But be that as it may, for all its volatility, the Nifty is holding on to its lows. Yesterday's low of 25,384, pretty close to the previous trading session's low of 25,378. At the higher level, there is supply, 25,600 thereabouts, because that's where the highs have been contained over the last 3 trading sessions. So the Nifty day's high for the last 3 trading session comes up for you. The street does not believe that this range is likely to break out. At the lower level, 25,400. At the higher level, 25,600. So this 200-point range is what everyone's betting for. Small and mid caps are the ones that I'm talking about. We'll keep an eye out on largely because domestic money will be at play today. And the other large index that may be in focus is Nifty IT. Because even if the Nifty is about 3% away, the Nifty IT is 16% away from its highs. Trump's spending bill being passed, stronger US economy, Q1 results soon. All of these factors should work for the IT stocks. And that's something I'll be watching out for.
Okay, all right, Mangalam, thanks very much for that. So we've discussed all the usual cues and laid them out on the table for you. But let's also not forget that there is a big regulatory order out there, and it's the Indian market regulator that has completely cracked down on Jane Street. And this is after months of analysis, even discussions with the Jane Street group. Finally, what SEBI is saying is that Jane Street has to be completely stopped from all action in the securities market. In fact, banks have been asked not to do any further debits with entities associated with Jane Street. Not just that, Jane Street has to give back that big amount. That's close to $500 million, over $500 million, almost 4,900 crores. This amount has to be impounded from Jane Street. SEBI's contention has been that it gave enough time, in fact, even a warning in February to Jane Street to desist from undertaking any activities which were in violation of securities laws. But it seemed that this remained unresolved, and Jane Street and its associated entities were still taking very large cash-associated positions while dabbling, of course, in the options market. And this goes back to an earlier episode where there were talks about market abuse, market manipulation as well, perhaps, especially on expiry days, when it came to very large positions in the options side of the market. We'll be discussing this with experts. We'll get Anuj to join in as well. But, this is a very strong message to all the large algo trading, institutions out there that market abuse or any sort of market manipulation will not be tolerated. And remember, the exchanges were a part of this investigation. The NSE had been asked to submit its report as well, which it did a couple of months back. And after the NSE's submission, a warning was given to Jane Street in February. Clearly, that didn't prove to be enough. And finally, there is this complete cease and desist order that's now coming from the regulator.
Indeed, one of the biggest crackdowns that we've seen on algorithmic and high-frequency trading in the history of India. We'll discuss that in greater detail. For now, let's invite on the show James Knightley, Chief International Economist at ING. He's here with us. James, thank you very much for joining in. First, let's get chatting about this big, bold, beautiful bill, which is soon going to become a law. Now, the Congressional Budget Office, CBO, is talking about a deficit of $3.4 trillion over the next 10 years. What are the economic implications of this bill for the US economy and even for the world economy?
Yeah, I think there's an important distinction that we've got to make. Firstly, this does add a huge amount of debt to the US government's debt pile, but it does very little. It does next to nothing to actually boost US growth because, in fact, if we look at what the effect is of this extension of the 2017 tax cuts, and that's what the bulk is, this is debt that now has to be acknowledged. But of course, because it's an extension, it means my tax bill doesn't change next year versus this year. Likewise, tens of millions of other Americans will not see a change in their incomes whatsoever. Moreover, what we've got to remember is that there's a huge amount of spending cuts as well. So overall, this bill is actually quite a significant headwind to the US economy in terms of growth. Also, remember on top of this, what other fiscal initiatives has Donald Trump introduced this year? One is tariffs. That's effectively another tax bill of about $2.8 trillion over the next 10 years. And on top of that, we've got the spending cuts from Elon Musk's Department for Government Efficiency, which is probably running at about $200 billion right now over the next 10 years. So actually, what we've got is an almightily massive debt pile coming through for the US economy to try and get people to lend to it but also it does very little good in terms of supporting US growth.
So in light of that, what do you think the US Fed would do from here on? Because on the one hand, you have, the US economy, the jobs data was fairly stable. At the same time, you have a lot of spending that the government is doing. All these tend to be slightly inflationary. This at a time when everyone's expecting it to go ahead and cut rates. The yields saw a bit of a spike yesterday. What's your own assessment of what the Fed would be doing from here on?
Yeah, I mean, obviously the Fed are under a lot of pressure. Donald Trump was last week saying that the Fed should cut 200, 300 basis points. And then two of the appointees that Donald Trump nominated back in his first term got in behind him and said, yeah, we could vote for a 25 basis point cut as soon as this month in July. But I think the rest of the committee are far more conservative. Jerome Powell made it quite clear that he thinks that the US economy is in relatively decent shape and that they've got time to assess the impact of the tariffs on inflation. That's what they're really concerned about, because if you remember back in 2021, 2022, the Fed was telling us inflation will be transitory from all of these supply shocks post-COVID. And of course, it wasn't. So the Fed really does want to make sure that it can give the green lights to rate cuts. It needs to see what the tariff narrative does. So I think we're going to have to wait another few months. I certainly think they will be cutting before the end of the year, but I just think that to get clear evidence that inflation is not more permanent because of these tariffs means that it may be a December rate cut rather than a September rate cut that the market is currently pricing.
James, hi. Morning. Can't really blame the Fed, can we? Because data out of the US has been so strong, so resilient, including the jobs report last night, right? It's almost like the US is gold-plated right now. Markets are surging. Macro data is looking positive. And so far, corporates have also pretty much held up. We'll see soon enough. On inflation, though, what are you penciling in? What is a baseline tariff case that you're working with? And therefore, what is the pickup in inflation that you're estimating?
Yeah, I think it's what we need to focus on are the month-on-month rates, because if we look in the context of what month-on-month inflation readings do we need to see to deliver 2% year-on-year inflation? It's 0.17. That's the key threshold. If the number comes in at 0.17 month-on-month or below, we're in decent shape. But if it runs hotter than that, we're going to be moving away from 2% year-on-year in terms of the run rate. So that's the key threshold. My worry is that over the next 3-4 months, we're not going to be seeing 0.17s. We're going to be seeing 0.4s, possibly 0.5s. And in that environment, I think the Fed's going to find it very challenging to justify cutting rates, unless, of course, the job market really starts to weaken very precipitously imminently.
James, just getting back to that earlier point about the bill, where you're saying that despite the tax cut, it's not going to result in a fiscal push and boost growth. And on the other hand, you perhaps will be looking at a bit of a debt spiral with debt ballooning. But the bond market in the US appears to be fairly sanguine, just going by the rate on the US 10-year yield. So, I mean, tie that in with us. Shouldn't the bond market be worried and signaling that?
I think it should be very worried. Well, the bond market itself is not necessarily worried. It's about getting the investors to keep lending to the United States government. That's going to be potentially a little bit more challenging because we've got to remember that there's two phases. At the moment, the bond market is focusing on the Fed, focusing on the lower Fed funds rate story. That's, I think, what the key driver is right now. But the medium to longer term is story when the Fed is no longer cutting, when the Fed is potentially going to be hiking rates. I think there's going to be a lot more nervousness about the bond market. What sort of returns you need for the risk that you run? And I would argue that we could well see bond yield come under upward pressure because we're going to see a wall of issuance coming through over the next few years. When you've got foreign investors which own 25% of the bond market, seeing the dollar continuing to weaken, and you've also got the Federal Reserve, which owns 15% of the bond market, still selling. It puts the real onus on domestic investors in the United States to step up, to lend to the US. And as I say, we're just a little bit nervous that we could see medium to longer term a lot more upward pressure on Treasury yields as the government tries to sell this debt.
Okay. All right, James, we will leave it on that note for this morning. Thank you very much for joining in with Perspective. We'll see what the next couple of weeks and days bring. Hopefully more clarity on the tariff front. Well, with that, let's move on and quickly tell our viewers more about what's lined up on the show over the course of the next 2 odd hours. Coming up at 8:30, we discuss the SEBI order on Jane Street threadbare. What does it mean, not just for Jane Street, but for overall market construct? Could it have any kind of implications in terms of trading volumes or sentiment? Gurmeet Chadda and Prakash Diwan will join in. At 9 a.m., we'll be joined by Nitin Agarwal of Motilal Oswal Financial Services. We talk about a lot of these Q1 banking updates that have been pouring in. What do the early signs tell us? At 9:20, Manish Gunwani of Bandhan AMC joins in. He's our market master of the day. At 9:30 a.m., we'll be in conversation with the management of JSW Infra. We'll talk about the company's FY26 outlook and their plans with respect to capex. After this, Shikhar Agarwal of BLS International is going to be with us at 9:40. We'll talk about demand trends amidst geopolitical tensions. And about 9:50, Rajiv Kale of Thomas Cook joins in to talk about summer travel demand and overall trends and expectations for FY26. And towards the end of the show, in our special segment, It's the Economy, Lata analyzes Credit Bureau CRIF's report on how India lends with Sachin Seth of CRIF India and South Asia Madhusudan Ekambaram of Credit B Financial Services, Kanika Paricha of Union Bank of India and Sudipta Roy of L&T Finance.
All right, with that, we'll step into a short break. But as we do that, we have a lot of stock-specific action to track today. We'll get to it in just a bit in our special top 10 segment. But today, we're looking at Bajaj Finance, Bajaj Housing Finance. We have Marico, AU Small Finance, L&T Finance, IEX, all of them on the back of their first quarter update. Defense vendors that are on our radar on the back of positive news flow. The big government spending bill that was announced yesterday. Bank of Baroda, Emcure and Trent are stocks that are likely to open in the red.
Welcome back. In a dramatic turn in the Indian financial markets, SEBI has barred the global trading giant Jane Street from accessing the Indian securities market, citing alleged manipulation, and they're also impounding gains to the tune of 5,000 crore rupees. Prashant is now joining in with his thoughts on this entire episode. Prashant, hi, good to see you.
Good morning, Rima. Good morning, Surabhi and Mangalam as well. You know, this is big, and it's in terms of regulatory action, perhaps as big as it gets. And the primary reason for that is for the last 2 years, if you remember, starting in the middle of 2023, we've been sort of reading, hearing about this sort of, entity called Jane Street. I mean, there are other entities in this sort of category of players in the market. There are players like Jump, Citadel, but Jane really, has been the focus of attention. If you remember, the first time these sort of articles started to appear were in the foreign press. Which I still remember that article which said that they made $1 billion in net profits that year. I think this was in 2023, and of course after that there has been a litany of press coverage on it. I remember the last sort of news item which came through was one of the Indian publications, long form publications, which said that the mysterious hand in the market, which moves market willy nilly, I mean, as they desire. So this is, in a way, the culmination of all of that, and the regulator is now stepping in. I'm sure you guys will, of course, we've been telling our viewers what has been done by SEBI in terms of asking these entities and asking banks which are holding the profits which Jane Street made not to be disbursed to Jane, not to be taken out of India. And of course, I mean, barring them from capital markets, etc. So the modalities of the order, I'm sure we've been sort of telling our viewers. What I want to do here, guys, is just tell you what SEBI has found in terms of their order, the modus operandi on the basis of which this order has been passed. So there are two sharp points. There are two sharp strategies which SEBI in its order has highlighted. Number one is, and there's been an inkling of this in the market for a while. Essentially, you take remember, the options market is much larger than the cash market, right? I mean, it's 300, 400, 500 times bigger than the cash market. On expiry days, even larger. So the inkling always has been that, this entity would move cash markets to benefit disproportionately in the options market. To give you an example, to move the cash market, you need much lesser amount of money. So, for example, you put in 5 rupees, 10 rupees to move the cash market to wherever you want it to. And this, by the way, is all happening in the same day. So in the morning, say from 9 o'clock to about 11:30 or so, in the first 2 hours of trade, you have, Jane Street moving the cash market, in the way that desired. So let me just give you a specific example. So buying 5 rupees worth in the cash market, at the same time, you're taking an opposite position in the options market. You're selling calls and you're buying puts, which essentially is nothing but going short in the market. So, cash market, you buy, the price goes up, say, for example, the bank nifty. And by the way, bulk of this investigation which SEBI has done is all on the bank nifty. Very little of it is based on what they found on the nifty as a contract. So in this example, you bought a little bit in the cash market. You were able to move the cash price on the basis of which all index options on all index values are determined. So the retail, the general audience, the public, for example, at large, sees the cash price go up substantially. Sometimes 500 points, 1,000 points. We've all reported on those wild swings during the day. And they think, well, the market's going up. But this entity at the same time is actually taking an opposite position in the options market. They're selling calls, they're buying puts. And then in the second half of the day, so this has happened in the first 2 hours, 2.5 hours. And in the second half of the day, you dump the cash position. So the cash price comes down dramatically to where it was before they ramped it up. And then you unwind your calls, the calls that you've sold and the puts that you've bought. And then you profit disproportionately with a small amount of position. You're able to move the cash market. And then you're able to sort of profit disproportionately in the options market through these calls and puts. And this, by the way, is all happening on a single day. First half, ramp up the price on the cash side, sell the calls, buy the puts, and reverse all of it in the second half. So this is one. Second, very quickly, and the second strategy, the second modus operandi, if I can call it that, is even happens in an even shorter time frame. This all happens typically in the last 1.5 hours of trade. So for example, these entities go short the Nifty bank in a big way using options, etc. And then you essentially sell so for example, if this is a bank nifty, you sell the constituents of the bank nifty in the cash market to drive the price down of the index itself, and then you square things off, and that's how you benefit. So the second one is pretty straightforward. The first one spread through the course of the day. So these are the two sharp kind of modus operandi which SEBI has found in its order, on the basis of which they've gone ahead and if I can call it this is a cease and desist order. I've also spoken with sources in SEBI who say this is a kind of a cease and desist order. Investigations will continue. Bulk of what they found is on the Nifty bank. This is all bank Nifty, mostly bank Nifty, but they suspect that similar things would have happened on the Nifty as well, into which investigations will continue as we go forward. I also asked, my sources in SEBI, whether other entities, it's not just Jane, there is, for example, Jump, there is Citadel, there is Millennium, whether other entities are also, have they found these kind of things with other entities, and can we expect something like this in terms of an order? What I was told is it's Jane. I mean, by far, in terms of the size of positions, in terms of the delta that they were running on a daily basis, by far, the number two player does not even come close. So no, the answer to that question from my source in SEBI was no, this is limited to Jane. But the point is, this is for now a cease and desist order, and investigations will continue into, what other tactics, what other strategies that they've used to sort of profit unfairly, as SEBI calls it, in its order. Guys, back to you.
Prashant, thanks for that, and thanks for putting it in context. And those strategies really explain perhaps what was going on. While there's nothing, it's not against the law to take one position in the F&O market and take an opposite position in the cash market or vice versa. I think the scale at which this was being done with the intent, that is where the problem was. It's been enough to pull Prashant back. Prashant, sorry, we had to, truncate into your, make inroads into your holiday. But, Prashant, just hang on for a second, because Anuj has also joined in. It's good to get Anuj back in the studios as well on this. Given the scale and magnitude of this news, Anuj, it's a large order, and it's a big message that the regulator is sending across, right? They're saying we're impounding close to $500 million. You've done wrong. We gave you time to, wind up your shop, but it hasn't happened. But my first question to you is, will it have any market implication, because Jane has to now wind up everything?
Surabhi, good morning. This is an interim order, and I'm sure that Jane Street will appeal it. And look, at the end of the day, we have to be very careful about this, and this is what Jane Street would say, that making money is not a crime, right? I mean, at the end of the day, yes, they disclose it. I'll tell you a very funny story, how this whole thing started. In April 2024, which is when we at CNBC Awaaz first picked this up, in 2024, Jane Street had a case against Millennium. They accused Millennium that Millennium poached 2 of their traders, and they made huge money because of that. And Jane Street said, look, we had a lot of resources on the system, which helped us make $1 billion. So that was when it first started. And next year, actually, Jane ended up making, that was in 2023. In 2024, Jane ended up making $2.3 billion from the Indian market. So $1 billion was an eye-popping number. $2.3 billion, of course, even more eye-popping. And Jane and Millennium settled their case, but it gave SEBI, a peek into what was happening. Again, this is no front-running case, so it will be very tough to prove, obviously, and I'm sure that Jane would go to SAT and then maybe even Supreme Court or whatever. But the issue here is, in a nutshell, what was happening, especially on the Bank Nifty, while the other order on Nifty and Sensex may also come. For example, on Bank Nifty, and we always say that Bank Nifty is very lopsided index. Why was this more prevalent on Bank Nifty compared to Nifty and Sensex? Because on Bank Nifty, you have 2 stocks, HDFC Bank and ICICI Bank, which primarily account for almost half of the index. So, you have one HDFC Bank which moves 1%. Now, you move HDFC Bank 1%. Suppose you sell a lot of HDFC Bank, but before that, you bought put options of Bank Nifty. And that HDFC Bank falls by 1%, but that put option from 100 rupees becomes 400 rupees. So that's a 4x return. And that is where obviously, when HDFC Bank falls all of a sudden, some funds will come and buy HDFC Bank, and the price will eventually go back to the equilibrium. And that's what was happening. Even if you look at yesterday's price move, look at what happened intraday in a lot of stocks. And that is where you will square off these positions and make huge money. So if you see the table, in index options, they made 43,289 crore, but they lost 7,680 crores in futures. Because that is where, you ended up losing the trade. The same would happen on the other way around. I mean, if you are buying call option and, you're doing that. So eventually that, in a nutshell, is what was happening. The market impact, you ask me, the market impact would be restricted to 2 or 3 stocks. I think BSE, for example, today could be one of the biggest casualties because, a lot of volumes on BSE, I am told, were being generated by hedge funds. So in that sense, there could be some impact, though my sense is at lower level, even that will see some buying because, first of all, this is not a final order. And second of all, I think this is going to escalate. I mean, Jane Street, obviously, if you're making $2 billion, you have deep pockets. You will fight this case, and you will put if needed 500 crores in the legal fees or whatever. But you will fight this case.
Jane Street is one. The other thing is that now that this has been unearthed, but a lot of other hedge funds would be doing the same from here on as well. So will this really stop at some point in time? Because this is, like everyone said, this is not entirely illegal. It's just positioning that they are taking. Right?
Yeah, Mangalam, that is where, I tell you earlier what was happening was that you had daily expiries. So, so to curb that, SEBI said, okay, we will now restrict the weekly expiry to 2 days. Earlier, we had Monday to Friday, all days expiry. Now, if you see, our volatility has restricted really to Tuesday and Thursday. Yesterday, for example, there was a lot of volatility. The whole issue boils down to whether, what Jane Street was doing was illegal in nature or not. Was it market manipulation or not? At the end of the day, making money is not a crime. 90% traders were losing money, but someone was making that money, and that mostly was on the other side. I think even Samir Arora had tweeted about it earlier, long back, that, a lot of these hedge funds are making money. Why are we letting them do it? We, as in the retail traders, because, there's no way you can fight these machines. You remember Terminator, right? You can't fight that machine. That is going to just kill you. So that is what was happening. The retail trader was getting killed. The whole issue, and I keep harping on this point, the whole issue is this will escalate. I'm sure this is not the final order, and Jane Street will appeal. Whether SEBI will be able to prove that there was something illegal about what was being done.
Yeah.
At the end of the day, it just boils down to that.
From my experience, I have traded prop for about a year and a half before I joined CNBC-TV18. Obviously, that time there weren't as many volumes. But the concern that time and the concern now is the same. The depth is not as much. If you do about $1 billion worth a trade, immediately the price impact will take place.
Especially on Bank Nifty. Especially on Bank Nifty, because that was, you have a 12 stock index in which 2 stocks account for what, 50% of the index.
Yep.
So that is where the.
That's really well put, Anuj. And let me quickly go back to Prashant for a final word on this. Prashant, really, that's what it is, the crux of it. And this could be fought out in the legal courtrooms, right? Whether taking opposing positions between the cash market and the F&O market, is it really illegal? Technically, it's not. That's what hedging is all about. But this is a different level of, algorithmic trading. Final thoughts?
No, it's going to be it's absolutely right. And Surabhi, I think we've discussed this on the show in the past as well, right? When we sort of spoke about as I said, this inkling was there. I mean, I saw this order at 5 in the morning, and I immediately said, well, because the inkling was there, well, this is what they were doing, that they would take outsized position in the options market, use a small amount to move the cash market, because, the cash market is much smaller, and then kind of sort of, reverse those trades in a very short time span. But just, guys, think about it, right? Over the last actually last year and a half, how many times have we reported on wild swings, 1,000 points, 1,500 point moves, just out of thin air, which comes, disappears, and then it's almost as if nothing happened. And I think, this order now and the modus operandi that I first explained, the two ways in which the markets were moved, explains so much, if you think about it. And of course, the legal matter, we'll leave it to the lawyers. There are securities lawyers, there are experts, there are SEBI officials, etc., who will who'll all weigh in terms of whether this is illegal, whether this is right, whether this is wrong, and whether Jane Street is liable or not. But just as as people who've reported on daily markets, hourly markets, I think what SEBI has put out in its interim order is an eye opener. And absolutely, as I began by saying, this is an interim order. I've been told very, very clearly the bulk of the focus has been on Bank Nifty. They've not really gone into what was happening in the Nifty in any great day, except I think one day on the 15th of May, I think, when they were when they found irregularities in the Nifty as well. But otherwise, this is primarily focused on the Bank Nifty. So once this order, as this order goes into effect, investigations will continue in terms of what they've done as far as the what has happened on the Nifty as well. By the way, for a lot of our viewers, Surabhi, Mangal and Rima, Jane Street would be sort of, people would wonder and scratch their heads and say, well, who is Jane Street, right? Who are these guys? And I think it's an absolutely legit question to ask. And the reason why many people don't know about Jane Street, unless you've sort of, so inclined to go in, dig in, and sort of, do a deep dive on who these guys are, it's because they are so secretive. And that goes back to the point which Anuj was making earlier. The first time I think all of us heard about Jane Street was when, I think it was Bloomberg which put out that story. This was back in 2023, that, there was a fight between Millennium and Jane Street, and Jane Street was suing Millennium. It's one of the most secretive sort of trading organizations in the world. I think by far the most secretive trading organizations in the world. And for those so inclined, I'll give you, if you want to read more about their strategies, etc. And of course, SEBI has shown us some of what Jane Street has done. But I think you can, there is an excellent biography of Sam Bankman-Friedman, SBF, right? He was, of course, himself indicted by US prosecutors, etc. The book was written by Michael Lewis of Liar's Poker fame. And there is about a chapter in that book. And by the way, Sam Bankman-Friedman worked at Jane Street for a while. And there is a chapter in there, in which, what Jane Street really did. And this came from Sam Bankman-Friedman in terms of what Jane Street did really came out. And I think that's one of the few publicly available strategies which were available before the SEBI order now, in which SEBI, I think, has clearly shown us at least 2 ways in which Jane profited, according to SEBI, unfairly, illegally, and of course, on the other side of the trade, the counterparty to the profits that they were making was Indian retail investor who were unwittingly taken to the cleaners. There's no other way to put it. Just look at the numbers which we're talking about here. Tens of thousands of crores in profits by one trading shop. So I think we can go on and on, but this is a landmark order in that sense. It may be an interim order, but it's a landmark order against a global trading giant. Not the end of it. Interim investigations will continue, but I think this is pretty massive.
Yeah.
Oh, indeed. And, SEBI has acted, in the past, say, against NSE, against, algo trading, etc. But the fact that this time you've passed an interim order against, a global giant, it's unprecedented so far. Thank you very much, Prashant, for joining in, and hope you enjoy the rest of your holiday.
Yes.
Let's invite Gurmeet Chadha, Managing Partner and CIO at Complete Circle. He's joining us on the show. We also have Prakash Diwan weighing in with his thoughts. Gurmeet, let me start with you. What would your initial takeaways be from this entire episode?
Yeah, hi, Bima. I think I agree with Prashant. It's quite a landmark order, and I think by the sheer size, I think probably I don't recall anything like this. But I think there is a line we need to draw between the technicality and the part of it being fair practice and impact on market stability and integrity. And SEBI is responsible for market stability and integrity being maintained. And if you see the order, it clearly mentions, obviously it mentions Bank Nifty incident, where on 17th of Jan, the HDFC Bank market reacted. Bank Nifty opened down post the update from the bank. And in first 7-8 minutes, you buy huge quantity in cash. And as a result, obviously the put option prices go down, and then you go short on the market, and then you obviously reverse it. And if you're doing that too frequently, and if you see the second page of the detailed order, it talks about how you create large delta positions, through very aggressive buying in a very short period of time, and then doing concurrent trades. So one is the technicality of it, one is the intent behind it, and using sheer power, sheer muscle to manipulate it. And I think the key word here is manipulation and being unfair in terms of prices. And I think to me it's just the right order. I'm sure there will be legal recourse done, and it will be a long drawn battle. But I think it's a good order, and it sends the right message that you hedge yourself, you trade, everything is fine, but there is a line you need to draw in terms of manipulating it and doing it the right way.
All right, but just to speak from the other side on here, Gurmeet, and speaking absolutely objectively, if there is an index which has been created, which has two stocks that account for a majority of the weight on the index, I'm sure it was just a matter of time before someone would actually, try to benefit from that lopsidedness of the index, right? So in that sense, do you think from here on, now that this has happened, the Index Reconstitution Committee will perhaps look at making it a lot more fair weight?
No, I agree with you, Najidar. And, end of the day, our markets, the way volumes have picked up post-COVID, I mean, we've added, 7-8 crore new investors post-COVID. And any market which adds, such kind of investors on COVID, obviously it will take time for the markets to get, the indices to get efficient. But I agree with you, the index constitution needs to be looked at. The frequent changes which we keep making to the index, which is free float market cap for one index and others, also needs to be looked at, because what we are also doing is, apart from this, is also making optically index look so expensive. If you keep shunning out stocks and keep getting new entrants basis the sharp price movement, I think some balance also needs to be done, and some thinking has to be done there as well. But I think as a regulator, if my investors are being manipulated into something, I need to act. And I think to me that's a fair thing to do. Changes in indices, constituents of indices, obviously this is an ongoing process, and even indices need to look. I think they've made this as a gambling casino machine. So many changes in expiry, every day some expiry. I mean, obviously creates so much confusion in the market. And look at yesterday's close, for example. Every day you see index moving 100, 200 points in a matter of 10 minutes for no obvious triggers and reasons. And this is not good for the market, in a market where we are talking of new retail investors coming in. So I think it's a good order, and I think more needs to be done. This is just probably a starting point.
All right, yeah, we haven't heard the last of this story for sure. Promises to be, perhaps a long, drawn-out legal battle. Prakash, hi, morning. What a busy morning it's become, thanks to this big order. Your thoughts? I mean, in the interim, in the here and now, as Jane winds up its positions like it's been told to do, I don't know. I mean, if it impacts other large algo trading firms, what's your sense? On just the trading side, the volume side of the market, would you expect any impact?
I think definitely. The restraint on the volumes and the methodology of trades done by Jane Street was supposed to be curbed much earlier. And the order actually talks about penalizing them for not having heeded that caution. which means that there will be a shrinkage in volume. And a lot of the others, names that don't probably feature in the interim order, but will probably be part of the full investigation, whether it's Citadel, Millennium, a lot of, domestic outfits, whatever, have been set up, will participate, will have to kind of, get covered. See, what it does is it draws a very clear distinction between speculative activity, which is to the ill effect of other traders or the overall market sentiment. The restriction is primarily been brought in on, has been crystallized because we have futures on indices, which is not the case in a lot of mature markets, including the US. You will notice that you have single stock futures, probably with a 1 year dated maturity, but not index futures. And that's precisely where, the trading in India has been a bit lopsided. There will be a lot of UN cry about FI saying it's not a fair, environment, and, you can't kind of be doing these things. You have to open up the market instead of restricting it. But the element, the segment of FIs possibly which gets impacted if there is a curb on this kind of activity on options particularly is very small. So, there will be a lot of noise, much more disproportionately higher than what actually the impact is. So this will cleanse the system. They will cleanse the system, make sure that capital destruction that was happening rampantly for small investors stops, which is good. But it will impact some of the capital market infra plays, right? We've seen how in the last 18 months they've done so well, whether it's exchanges, brokerages, a lot of those elements. So there will be an impact on that. But I don't think the overall market gets bullied by this. It'll probably be much, much healthier. And the regulators made it very clear that they will not be sitting down just because somebody is kind of out there with much more money to be traded into these options.
Take that point entirely, Prakash. Thank you so much for joining in. The impact of this could be limited as of now, as per Prakash, to just the capital market plays on account of this. Gurmeet says that we haven't heard the last of it yet. It'll be very interesting to see where this goes from here on. Thanks a lot, gentlemen, for joining in. Just a closing word on this, Surbhi. When the futures market was created world over, it was on three basic tenets. The three things that futures market was created on. The first part of that was hedging oneself. The second part was arbitrage. And the third part was speculation. So speculation is part of the futures design by itself. So let's see where this goes from here on. So we'll most definitely keep an eye out on how this story develops. But for now, what we'll do is take a short break, come back on the other side. All fundamental stock talk with Siddharth Khemka of Motilal Oswal Financial Services. We'll also get to some stocks that are in the news. Welcome back. You're watching us here on CNBC-TV18 Bazaar Morning Call. Two stocks that I'll be watching out for, both from the consumer space. Marico, good first quarter update. They've said that improving rural sentiment and urban trend steady has actually taken their underlying volume growth in India to a multi-quarter high. For me, the biggest positive this time around was value-added hair oils grew in double digits. This has been an underperforming segment for the company for the last many quarters. International business has been continuously doing well. So all of this means that the consolidated revenue growth for Marico has been low 20s. In a sector partial for growth, low 20s for staples is fairly good. Remember, gross margins are under incremental pressure, but operating margins have seen a mild improvement over the last year. There has been overall margin compression, but 20% plus growth, the street will take that with both hands. On the other hand, for one company, 20% growth is great. For the other, not so much. The company that I'm talking about is Trent. The company held its annual general meeting yesterday, and they said that the first quarter growth is seen around 20%, which is much lower than their own 5-year CAGR of 35%. I remember a couple of weeks ago when they met analysts, they said sustainable growth for the company is around 25%. So to that extent, 20% at a time the stock has seen a sharp recovery from the lows would be a negative, and it has prompted brokerages to cut their revenue and EBITDA estimates for this year, and they've downgraded Trent to hold, revised the target price lower as well. That's Nuvama. Let's get in Siddharth Khemka, Head of Research Wealth Management at Motilal Oswal Financial Services, on his views for the same. Good update coming in from Marico, not so much for Trent, Siddharth.
Good morning, Mangalam. Yeah, glad to be on the show Friday morning. So yes, I definitely see that the update from Marico is quite heartening, especially in an environment where the staples businesses are struggling for growth, and in that environment, Marico reporting a low 20%, but still a strong number for the from the industry perspective. So good quarter. We are seeing gradual improvement in overall consumer sentiments on back of easing inflation, favorable monsoon, as well as some of the policy stimulus. So overall, we remain positive on Marico. We believe that the companies aim to achieve the double-digit growth in this year. That is playing out well. And again, as you rightly said, there are some short-term pressures on margins, but that is also easing out. And hence, what we are expecting is about 11% and a 13% EBITDA CAGR over the next 2 years. But among these staples, I think Marico stands pretty strong with that update. So we continue to like it, and we like the stock from a long-term perspective.
Okay, all right, got that. Siddharth, stay on. We'll have more questions for you in just a bit, but we do have to take a very, very quick break. Come back on the other side. We'll, of course, start getting our pre-open rates. We'll get to our technical experts as well on today's trading setup. Welcome back. Just a quick check across Asian markets and what we're getting in terms of the implied open. Asia is very mixed. Some of the markets are doing okay. For instance, Japan is a little flat. Mainland China seeing a minor gain. But the Hong Kong market and the Taiwan market, they are slightly lower today. So the enthusiasm of Wall Street, that's not quite rubbed off on all the Asian markets. That's the implied open, fairly modest, fairly muted, just 11 points higher. We'll do one thing, take that quick break and come back with today's trading cues in just a moment. Welcome back. Just a quick check across Asian markets and what we're getting in terms of the implied open. Asia is very mixed. Some of the markets are doing okay. For instance, Japan is a little flat. Mainland China seeing a minor gain. But the Hong Kong market and the Taiwan market, they are slightly lower today. So the enthusiasm of Wall Street, that's not quite rubbed off on all the Asian markets. That's the implied open, fairly modest, fairly muted, just 11 points higher. We'll do one thing, take that quick break and come back with today's trading cues in just a moment.
watching us here on Bazaar Morning Call, 16 minutes before we open, 1 minute before the pre-open. And good time to get in all the technical experts. 10 points higher on the GIFT Nifty. We have Shrikant Chavan joining in along with Mitesh. Mitesh, good morning. After a big decline in the last 30 minutes yesterday, what do you think the market setup is like? Are we still in that range?
Good morning, Manu. I think, what has happened in that last 1 hour, which the market turned negative, was that the bank Nifty structures turned weak. And bank Nifty does enjoy a significant weightage in the Nifty, and therefore, I think, we could see some pressure in the coming days as well. I also mentioned that in case we start getting below 25,400 and just below that is where we crossed, good chance that we might actually drop down to about levels of 25 to 200 zones, which is where the next medium-term supports kind of kick in. So maybe I think we'll go down to that level. The range will be 25,200 to about 25,650, 700 on the upside. And looks like we are poised to head towards the lower end of the range.
All right.
Got that. Shrikant, what would your index call be?
Good morning, Rima. Good morning, everyone. See, for Nifty, the overall trend for the market is still bullish. We saw a spectacular rally from the lows of 24,500 to almost 25,500, 600. And now it is resting. So we are witnessing some correction, and in that correction, there can be the possibility that the market may again retest the levels of 25,200 or 25,100, where the market has spent a lot of time in the past when it was rallying from the lower levels. So close to those levels, the market is having support. But at these levels, we are witnessing good amount of selling pressure in banks, NBFCs, real estate. Actually, all these particular sectors did really well in the past. I mean to say in the previous month. But in this month, we are witnessing selling pressure. And also, if we consider FI's activity, then they are also selling on a day-to-day basis. So broadly, I am of the view that in the near term, we may see some correction close to 25,200, 100. Traders or investors having opportunity to create some long position, contra position of going long. But at these levels, we should be careful and we should look for creating short positions with a final stop loss at 25,600.
Shrikant, hi, morning. We want to know about your individual stock calls as well. But just before that, in 30 seconds, we spent a lot of time discussing the legality around this whole Jane Street order. But purely from a trader perspective, do you see it having any near-term impact next 1-2 weeks on volumes, on trading? If at all you have a view. Quick 30 seconds and then your stocks.
No, I think we need to go through with what position or maybe stocks he's holding in. Fund is holding in his portfolio. That is very important. But I don't think that is going to impact, because market is so big that all these things matters only on specific days like weekly expiry or monthly expiry. Otherwise, I am of the view that the overall the impact of the same is going to be very, very negligible. But yes, definitely it will help to curb this volatility.
Okay. All right. Good to know that. Stocks now for today?
Yeah. So based on the weakness of the market, I am of the view that we should look for creating some short position on ICICI Bank with a target of 1375. It's a very short-term sale with a stop loss at 1450. And the other stock which we like is Amber Enterprises, which is around 7300, 7350. The overall space is doing well, consumer durables. And in that specifically, we like Amber with a target of 7800. And we can keep a stop loss around 7100 for buying Amber.
All right. And Mitesh, your stock picks?
Well, I have a mix of buy and sell calls. On the buying side is BSE with a stop at 2790 for targets of 2885, and Oil India is a buy with a stop below 444 for targets of 470. While on the selling side is Rhoda Builders, keep a stop at 1390 or above 1390 and for a target of 1315, and Cholamandalam Finance, that's a short-term sell with a stop at 1550 for targets of 1475.
Got that. By the way, pre-opening rates are in. Marico's on the way up. Along with that, you've got Bajaj Finance in the green. And on the way down, Trent, the pre-open rate suggests a big fall, 6.5% down, while HDFC Bank too could see a little bit of red. In fact, a whole host of banking and NBFCs reported their Q1 updates, lots of them. But Gaurav is here just to tell us the key ones we should watch as we begin trade today.
Well, yes, first let's talk about Bajaj Finance. A very big positive surprise is what we have seen from the quarterly updates. 26% AUM growth, let me correct, 25% AUM growth on a year-on-year basis, which results into 6% sequential growth. On the other hand, customer base also increased almost by 21%. In fact, now brokerages also believe that this is going to be positive and the next checkpoint is going to be credit cost. Bajaj Housing Finance also followed the same trend where 24% growth is what we saw in AUM, and at the same time disbursements also grew almost by 3% on a sequential basis. On the other hand, let's also focus on some banks. Bank of Baroda actually came up with a little bit of weak set of numbers if we compare it with the expectations, because the loan book growth was at around 12.5%, while deposit growth was at around just 8% on a YOY basis. AU Small Finance Bank actually came up with good set of numbers. We saw advances growing at a rate of around 23% on a year-on-year basis, whereas deposits also grew strongly at around 31%. But let's not forget that this bank has also seen a rally in the recent days, so definitely watching out on this counter. And lastly, let's also focus on L&T Finance. Good set of number here also we have seen. Retail loan book actually increased almost by 18%, whereas when we talk about disbursements, there we saw 18% growth on a year-on-year basis, which also translates into around healthy growth on a sequential basis as well. So definitely a positive set of numbers from L&T Finance, and on back of this, we are watching on this stock as well.
All right, take that point, Gaurav. Thank you so much for joining in and giving us your views on all the updates that came in post 3:30 in the financial space. Nitin Agarwal, who's the Senior Group VP Head, BFSI Institutional Equities at Motilal Oswal Financial Services, joins in as well. Of all the updates that have come lately, what has been, according to you, some of the standout numbers, both positively and negative surprise, Nitin?
Yeah, hi, sure. Thanks for having me. So far, the business updates reflects a modest growth in the overall banking business. Some banks have reported a decline in their advances portfolio. AU Bank has relatively reported better numbers on both loans and deposit side, while RBL numbers also seemed in line. HDFC Bank numbers have come in today, and while the deposit traction remains in line, they have reported a 1.5 to 2%, slightly close to 2% kind of deposit growth Q on Q, but advances growth is almost flattish to less than 1%. So, which is something that is expected also, given how the RBI, we know that data is going on advances front, and expectations are of a lagged recovery in advances growth over the year. So I will say, barring the decline that has been reported by some banks, which is a little bit of a negative surprise, I think the rest of the numbers are broadly in line to our estimates.
Nitin, hi, morning. I guess PNB is the one, right, where the growth is lower. I'm just going back and checking the numbers. Yeah, their advances, domestic advances have grown 9.7%, which is lower than their overall guidance for the year. But I mean, just looking at the starting Q1 trends purely in terms of growth, I'm not talking about margin right now, purely in terms of growth, which would be the banks that you'll really watch out for?
So I think, AU Bank is one wherein certainly we are looking growth to sustain in early 20s. Because it could have been mid-20s also had it not been for MFI, which is, again, we are expecting a decline Q on Q. And so that's certainly going to be on the higher end of the range within our coverage universe. Rest of the banks, I think growth rates over the year will be low to mid double digits, is something that we are looking at for most banks. And that's essentially because the system growth also, we are looking somewhere close to 11 for the year. And our hopes are pinned around a recovery in the second half. Because first half growth may remain a little weaker and may run around 9-10% range is what we think.
So, the question, Nitin, really that a lot of investors are wondering is whether they're better off looking at tier 2 lenders. You're only looking at banks, or I'll restrict this to banks, rather than stay put with the comfort of, say, an HDFC or an ICICI, which I guess market wisdom is maybe they'll give you 10-11%. Tell us, in fact, what your estimates are. So the question is, between large banks and mid-sized banks like an AU you've singled out, but are there others which perhaps could be just a better investment this year?
I think you will still have to look at it on a case-to-case basis, because while mid-sized banking space has done well, and there are certain names like even we upgraded RBL Bank last quarter, and that has done fantastically in the current quarter. And the expectation is that with MFI stress receding and margins, after having seen an initial decline in the 1Q and possibly some bit in 2Q, these banks will do much better on the margin line, and alongside the credit cost benefits will also start to come through. So that will drive a healthy recovery in ROAs for these banks, and therefore the growth also can recover from where the trajectory is right now. So over the year, yes, if you take a next 12 to 18 month view, these banks can do well from where they are right now.
So RBL and AU small, right? I'm just confirming the names, the mid-sized banks that you like.
Yeah, so we like AU Bank, we like Federal, we like RBL, though Federal is still relatively larger, but we like Federal and we like RBL Bank.
Any trend that you can spot from the PSU banking updates? Because PNB yesterday was weak. Today we've got Bank of Baroda. And again, here the deposit growth has been muted. It's declined on a quarter-on-quarter basis. Is there any trend in the PSU banks that you can spot so far from the provisional updates?
I think, yes, BOB has reported a decline while we were expecting a flattish kind of positive growth at least. But Q4 was very heavy in terms of business accretion that the bank reported. So it seems like some unwinding has happened on both the fronts, both loans and deposits. And that has resulted in a decline. And we have to watch out the trajectory here on, but I don't think that there is a reason to change the growth estimates for the year because 1Q is known to be a little seasonally weaker. And some banks which have reported a marginal growth, other PSU banks like PNB. But I think over the year, we are still expecting growth rate to sustain around 10 to 12% range for these banks.
All right. Where do you stand when it comes to IndusInd Bank? Because, earlier we had Nomura, turn positive on the stock. Very recently, we had Goldman Sachs turn negative on the stock. The stock is down about 40-45%. Everyone's awaiting the leadership change out there. How much of that is realistically in the price?
Yeah, so I guess we are somewhere in the middle. We have still maintained a neutral call. We released a note today only on IndusInd Bank. And so what we have done in this is we have taken off the bear case multiples. Earlier, we put out a target of 650 on the stock, which we have revised to up to 800 now. And the rationale is that with the impending appointment of the CEO, I think one will look forward to how strategically the bank moves forward and decides on the growth and the earning outlook shapes up. So the negativity that was there since last few months, more than a quarter, I think more importantly, what we are watching out is that there shouldn't be any more one-offs or regularities related hits that the bank will take, which I think is the view that we are taking right now. And while operationally things will take to recover, you will still see a muted business growth this quarter. Margins will likely take a further dip from the normalized number of 4Q. And gradually, we are expecting ROAs to recover towards 1% over the next few years. So which is where we still maintain a neutral call on the stock. But we are keenly awaiting this clarity on the management and the strategic direction and the new management.
Absolutely. It's not for the faint-hearted because you have to, go through this transition period and then see how the bank emerges. Very quickly, last question, Nitin. You gave us a couple of your top picks on the mid-cap banking side. Let's come to the big boys as well, the large banks between ICICI, Kotak, Axis, SBI and the others. What would your top picks be and why?
Yeah, sure. So we have been positive on ICICI Bank and HDFC Bank. And we have maintained this call within PSUs. SBI remains a preferred pick. And I think post this capital raise, SBI, I think the overhang will go away. And you have already seen a catch up with many of the other PSU banks. If you look at, say, Union, Canara, Indian Bank, these banks have done fairly well in the recent months. The return can be between 15 to 25, 30%. And I think as you move forward, the valuation gap now between SBI and the other PSU banks has narrowed significantly. So post this capital raise, I think that overhang will go away, and alongside a recovery in the overall earnings line as the margins start to recover over the second half for most PSU banks, I believe, will drive a re-rating in the stock. We still maintain, of course, a buy on SBI with a 925 target.
925 on SBI. Nitin, thank you very much for joining in. Let's talk about Reliance. Because there is some internal restructuring plan for the retail business. Ashmit joins in with the details. Ashmit.
Well, Reliance Retail now looking to hive off the part of the business that dealt primarily with FMCG and looking to house that under one arm, under one company, which will then be a direct subsidiary of Reliance Industries. That's the long and short of the filing, the application that Reliance Retail has made before the Mumbai bench of the NCLT. Now, what we understand is that currently the FMCG business is housed between Reliance Retail in part and partly under Reliance Consumer Products. What this application suggests is that there should be a new company by the name of New Reliance Consumer Products, which will now be a subsidiary of Reliance Industries. That's, of course, the proposal that has been made. Now, the rationale that has been put forth before the NCLT is that FMCG business by itself is a large business. It requires specialized, focused attention. It requires a different kind of expertise. It requires a different kind of skill sets as compared to the retail business. So essentially distinguishing the FMCG business from the retail business. Then subsequently, the application then also goes on to say that this business will require large, focused amounts of capital going forward, and that this hiving off, this demerger of sorts, will allow for attracting of these different set of focused investors, which will be primarily directed towards the FMCG business. That is also something that's on the cards. And finally, the application also goes on to say that that the consumer brands business, the FMCG business, is not a part of the retail business, strictly speaking, and therefore there is a requirement for housing this, for placing the FMCG vertical under a different company altogether, and that this is a part of an internal restructuring exercise. Now, what we understand is that this application is currently pending before the NCLT. The NCLT, on its part, has directed for Reliance Retail to get approval from its shareholders, to get approval from its creditors, both secured as well as unsecured. Subsequently, there is also a direction from the NCLT to give a clear list of any pending dues in terms of IVC.
Okay, Ashmit, sorry, cutting you off there. Apologies, we're running into market opening. Got the gist of it. Thank you for that update. That's an important one. As the restructuring gets underway with respect to Reliance Retail and the consumer businesses. There's the bell, and the stock you need to look out for is Trent. It's down 8% straight away. The market's up. Market's actually opened higher. It's opened better than what the implied open was indicating. Nifty is about 10-11 points up, but the mid-cap index is already flashing red, so it is slightly volatile. Like I said, let's straight away flash Trent, and Mangalam highlighted this earlier as well. What the issues here are. The company has spoken about 20% growth in Q1. Their own, steady state guidance is 25% on an ongoing basis, but they've grown 20%, and that disappointment is written all over the stock. We'll go back to this in just a second, but that's your big headline. But otherwise, the market's managing about a 25-point gain. So let's see what's pulling it up. Bajaj Finance, like Gaurav told us, numbers are looking good, about 25% growth. Market likes that. Stocks about 2.5% on the higher side. We're seeing some move on a BEL. Need to watch out for some of these defense stocks as well. Like I said, over 1 lakh crores of proposals approved by the Defense Acquisition Council. BEL is already up and about. Wipro, Bharti Airtel, Bajaj Finserv. These are some of the other early winners. HDFC Bank is managing a 0.5% gain. But then it's getting really quiet. Reliance, for what it's worth, is adding 3 rupees. Sum total of 3 rupees. So it's not too much of a contributor. Markets holding on to the green just by the, hanging by a thread, so to speak. On the flip side, you've got a M&M, Tata Steel, Tech Mahindra. These are some of the names on the downside, only 7 points higher. It is volatile. It's not a clean sweep. So the optimism on Wall Street hasn't quite translated to the Lal Street just yet.
Well, on the way down, by the way, it's the capital marketplace. So clearly this Jane Street's, the interim order on Jane Street impounding gains to the tune of 5,000 crore is hitting some of the capital marketplace. So pull up an Angel One, straight away 5.5% lower on that. BSE is open with a cut of about 4.5%. A Motilal Oswal, CDSL. So the entire capital market complex today is under pressure. The street fears that liquidity will get impacted, market making will get impacted, and that is hurting sentiment there. Trent, of course, is the big loser. Outside of that, on the way down, you also have cuts coming through on Bank of Baroda, where the street is a bit disappointed with the provisional updates. That stock is open with a cut of about 0.5%. On the way up, as a sector, it's the defense names. So Paras Defense, Bharat Dynamics, BEL, that's the complex which is higher today on the back of the Defense Acquisition Council clearing orders to the tune of 1 lakh crore rupees. Marico has started with strength after the volumes hit a multi-quarter high, 3.5% up on that. IEX has a bit of a gain going for itself. And some of the other big movers include a Sapphire, that's up nearly 4.5%. A few other NBFCs, Suryodaya Small Finance Bank, Credit Access Grameen, also up and about. But on the whole, very, very flat on the benchmark indices. Nifty sensex holding up with a mild positive bias, mid-caps unchanged.
Flat on the benchmark indices. We do have, the advanced decline pretty much at an even keel early in the day so far. Metal stocks have taken a knockdown as well at the open. So we have Tata Steel, which is about 1% lower. And at the same time, a large part of the weakness in the capital marketplace could also be on account of the update that has come in for the month of June from Angel One, where the gross client acquisition is actually down 41%. The number of orders themselves have declined by about 32%. So yes, there is that cloud of the Jane Street thing, but at the same time, fundamentally as well, their update for the month of June hasn't been very good. Speaking about weak updates, definitely has to be Trent. You know, the stock had seen a rally all the way up from 4,500 to close to 6,000 on hopes that, you know, growth will return at some point and valuations are getting comfortable, but growth hasn't returned. And in light of that, valuations also seemed a lot higher. I'd like to see what Avenue Supermarts does, because if the company or the quality of Trent is growing just at 20%. Yesterday, Avenue Supermarts was down 4% on account of a 16% growth. So will Street give a longer rope to Avenue Supermarts right now or not is something that I'll be watching out for through the course of the day. Marico, 4% higher on the back of 20% growth. That definitely is your stock of the day on the way up. We're also seeing some traction on, a couple of these jewelry companies. So they are doing well. We are awaiting, updates coming in from both Kalyan as well as Titan. And I also watch out for Dabur as well. If Marico is growing well, will Dabur continue to underperform the industry as it has, or will that also get its act together? The Street is betting on perhaps it may see some improvement from
Marico has finally put it out there. They're saying that, yes, we're on track to perhaps finally getting back to double-digit growth for the year as a whole, right?
For Marico, they've been saying that all of last year as well and this year. And Marico has gone ahead and, delivered that too. Yeah. So from a stock standpoint, Marico's seen a lot more in terms of re-rating. And it's done well because their volumes have outpaced the industry for the last 3 or 4 quarters. The only problem was the margins, largely because of higher input prices. But here as well, the commentary is positive. They're saying that things will improve in the second half of this year.
Well, it's really interesting. You put 2 stocks today, Marico on one side and Trent on the other side, both from the consumer space, but very different dynamics, different market positioning, leading to the...
Both from the consumer space and both growing at 20%, mind you. So it's just a valuation. Marico's 20%, Street likes 4% higher. Trent's 20%, Street does not like the stock down 8%.
It's positioning, it's expectations, it's valuations, all of that.
But as someone was pointing out, it's also Trent's growth rates have been decelerating, right? I'm just going back over the last 4 quarters, 29% in the prior quarter, 37% before that, 40% before that, and 57%.
Yeah, so which is why we saw the derating as well.
You've seen that derating.
Mark, the stock went down to 4,500. From there, it saw an improvement because the Street believed that there could be some improvement. And the company themselves said that it can grow at 25%. So the Street was adjusting itself to the new normal of 25%.
Now it's 20%.
But it's 1 quarter, you don't know. And they say one swallow doesn't make a summer. So let's see. Actually, let's take this debate forward with Manish Gunwani, head of equity at Bandhan AMC. Manish, good morning. Thank you for joining in. It's a very spirited Friday morning here in our studios because we have the big Jane Street news and all these earnings updates coming through. So a fair bit of excitement. But actually, let's start with the consumer debate and what we're seeing play out. A lot of participants in the market want to pivot back towards consumer stocks because they've not done too well. But you need hard evidence that growth is coming back. What's your sense? Are you liking the space? What's the positioning here? And what kind of consumer companies would you prefer, if at all?
So I think the macro is positive. If you take a medium-term perspective, I think multiple things are happening. One is the tax cuts. 2 is, I think, interest rates coming down. So EMI is coming down will help consumption. If you see the pay commission, which may come anywhere between 18 to 24 months from here, that has also been typically a good trigger for consumption. And I think overall, if the economy does well, given that monetary easing is happening, that should also help. But yeah, the challenge is more bottom up there because consumer stocks in India tend to be super expensive, actually. So a lot of the staple companies, the discretionary companies are not cheap. So I think sometimes going down the market cap curve helps. There are some consumer companies which are at 1 to 2 times sales, obviously because they've not done well. I think it's good to probably have some exposure to them because if the cycle comes, typically in India, any consumer brand goes back to 3 to 6 times sales. So I think in the large cap names, it is a bit difficult to be very excited, even if you're positive from a top-down perspective, because you get about 1 to 2% free cash flow yield for 60 times. So yeah, I mean, top-down is good, but other way to play it is through auto. But there are some technological challenges, obviously, in four-wheelers, etc. So I think you'll have to mix and match a bit here.
Manish, I think, your preference for small caps is not restricted only to the consumer stocks, because I am reading your note and you believe that there are many industries in the 250th to 500th name in terms of market cap, which are offering massive opportunities for investment. Can you throw some light on, what prompted you to look so down the curve, and what are the opportunities in what sectors?
So in general, I think there's obviously a lot of choice beyond large and mid cap. Obviously, not very liquid, so finite amount of money can be deployed. But I think it's just that the large caps, given that penetration-driven growth, I think in India is structurally peaking out, to be honest, because our demographics, our penetration of a lot of these products is very high. Like if you see two-wheelers or a lot of other basic stuff, we are probably by volume today among top 1 or 2 markets. And therefore, you can't really bank on, opening new markets and getting growth. In that case, you have to play something which is getting premiumized, where it's becoming a bigger part of customers' wallet. And as I said, then you also need valuation on your side, right? I mean, so for example, I think one of the distressed media companies is a good option value for us. One of the not so well-performing branded apparel players is an option for us, because all these are available at fairly cheap valuations versus a lot of the very large companies.
Okay, so you're betting on some of the non-performing stocks. So one which catches your attention is in media, and the other one is in the branded apparel space. So not going with the winners right now. Manish, since you've been in the markets now for so many decades now, you want to share your thoughts on SEBI barring Jane Street from the market? I mean, how should one go about thinking about this? Are there any implications for capital market plays in India?
Honestly, don't have any strong view on this because being a fundamental investor, it's very difficult to figure out what exactly is happening in the derivative space. So yeah, I'll kind of pass this because I really don't understand how this issue actually is being handled.
Okay. The last time we spoke, you were bullish on financials. I think you were overweight on financial. Does that view still hold? Are you incrementally more positive now, or have you been adding to your stocks? And tell us in your portfolio, which would be the top bets now in the financial space?
So I think financials, I'm quite bullish. I think that's the one of the few spaces where valuations are interesting. Having said that, again, I don't expect very high growth in banks, which are a big part of the financial space. But I think general insurance, life insurance, AMCs, these are interesting spaces. They may also not look cheap now versus 2-3 years back, but at least when you see the market caps, you can say that these market caps are still very low versus what is going to happen in the next 5-10 years. So I do think that financials are one of the most interesting space in the market right now from a risk-reward perspective. So we are, in general, overweight a lot of segments, including banks, but more structurally, I would think AMCs and general insurance and life insurance.
Okay. Got that point. Manish, overall for the market, what's the sense? Would you be expecting a bigger move in the second half of the year, or do you think this is pretty much it and now it just boils down to individual stocks and earnings? When are you optimistic on a big earnings recovery and a major push through in terms of flows, etc.?
Not clear on very high GDP growth coming through, but I think the macro is too good, the micro is too challenging. So I think what I mean by micro being too challenging is there is obviously not very broad-based earning acceleration, and a lot of stocks are expensive. There's a lot of supply. So in spite of macro being super attractive to my mind, I mean, the currency looks solid, inflation, current account deficit looks solid. The top two economies in the world are very difficult to invest in. I think the US government debt is going to become a big issue. So there'll be money flowing out of the dollar, I would think, on a medium-term basis. So the macro looks super positive, but the challenge is just the micro in terms of getting stocks at reasonable valuation where there's not too much of competition coming, where there's not too much of supply coming. So I do think that between this tug of war of macro and micro, you probably get a flattish market, and hopefully if you are able to choose the stocks right, so it's a very peaceful environment for stock picking because nothing is moving up too fast. So you don't want markets to be very volatile. So it's a good market, I think. It may not be very exciting, but it's going to be interesting market, I think.
Where do you stand on the global facing names? Because domestic macros you said are great, but domestic micros from a stock standpoint, not particularly good. On the other hand, global macros, very uncertain. But from a stock specific standpoint, IT stocks or stocks which are, having some sort of global exposure have been suppressed because of this uncertainty in global markets. Do you think they'll come back at some point?
Very difficult to be excited about global sectors. I guess the biggest issue today is, as I said, the US government debt. Whatever way you cut the numbers, it's a very difficult issue to resolve. And I think what probably global markets are building in, because when you see most of the markets are at all-time high, that the end game is quite likely going to be that US will run negative real rates and Fed will print money, because otherwise the demand supply of US bond doesn't resolve very easily. I think that is, to my mind, driving gold, Bitcoin, equities, everything. And from that perspective, maybe metals is a okay contra trade, not a very high conviction thing, but if eventually QE has to start, or whatever form Fed takes to support the US bond market, a lot of the metal names, the commodity prices are not very high. The stocks are cheap on a free cash flow yield basis. But overall, it's going to be very difficult to figure out how this thing resolves. But yes, the more benign interpretation is it will force, not only US, I'm talking of most of the developed worlds, that, and Japan's been doing this for years now. And so if you see, Japan incidentally has same inflation as India, but the 10-year yield is 1%. So the point is, eventually, if this leads to globally negative real rates coming, I think that prospect, I think, is keeping most asset prices high.
Okay, lots to think about as we look at some of these global macros and how they play out. And of course, lots to track here in India in terms of earnings and what really is hitting the mark. Manish, great conversation this morning. Thank you very much for joining in. We look forward to connecting again soon. Well, by the way, before we move to our next corporate conversation, the market for a bit dipped into red. Now it's flattened out, but it's absolutely quiet. So none of the Wall Street enthusiasm has rubbed off. And we've been, in this zone, in this block of around 25,400. Now, for the better part of the last at least two sessions, including this morning. So let's look at that. As flat can be, 0.00% on the Nifty. Well, so let's move our focus then to corporate conversations. The next company on our radar is JSW Infra. News reports are suggesting that the company is all set to win a big order, almost 832 crores. This is for mechanizing 2 berths at the Netaji Subhash dock at the Kolkata port. Let's talk about this and the overall roadmap and growth plans for the company. Lalit Singhvi, Whole-time Director and Chief Financial Officer at JSW Infra, is with us. Mr. Singhvi, thank you for joining in. Can you confirm, whether indeed you have got this particular contract? And if so, how does it make business sense for you? What will it add in terms of revenue visibility over how much time? I think you're on mute, sir. If you can unmute yourself.
Thank you, Shirvi, and for having me on your show. So regarding this Kolkata thing, we have yet to hear from the Port Trust, officially. So once we come to know, then we can talk more in detail. Bids were invited, and so final decision, official communication or LOI is yet to receive.
Understand, sir, that's... Yeah, exactly. I understand. So you can't exactly confirm till you hear it from the Port Authority.
Yes.
But you were going to, I think, construct and mechanize. It was 2 separate berths at this particular facility.
Absolutely.
And from what we know from reports is that yours was the highest bid price of 4,678 per TEU. So tell us, why were you interested? Why are you interested in being a part of this project? Why are you interested in this asset? And again, my same question. How does it help you in terms of revenue visibility? How long is the gestation period for a project like this? When does the money flow in?
So generally, if you see that we have been very active on acquiring the terminals at the major ports. We are the largest concession holder in India, having 9 concessions already with us. And we keep participating to acquire these terminals, and this makes a very good business sense for us. So if you see our cargo profile, we have 50% revenue comes from the private ports and 50% almost comes from the terminal side, which we acquired from the government. So in line with that, we keep bidding the good assets, and to have a presence in the container segment. That we are largely, we are bulk and a liquid company. On the container side, we have presence on the Mangalore container terminal. So we are looking for the good assets. So we found these assets to be quite good and strategic fit into our scheme of things. So
what are the volume projections, sir? You would have done, obviously, your back-of-the-envelope calculations. Yeah. What would be the volume projections with this project?
This has a capacity of, say, 450,000 TEUs, and they are already running at 90% capacity utilization. So there is there is no dearth of cargo. So they cater to the east side, and Kolkata is the main market for this. So we don't foresee, and we will run it more efficiently. There are no night operations type of things, and we will try to do and optimize after putting up a good cranes and whatever the mechanization we need to do. So after this will further, their operational efficiency will increase and give them more cargo.
Okay. So if you do win this, how will you fund it? And, it's a good asset, as you said. What would be the peak revenue that you would expect from this? And what would it do to your overall volumes? You would have done the math.
No, that is, this particular thing, as we said, that 90% utilization is already there. So we don't foresee, and the funding of this, for 800 crore project is not an issue. We are having a very strong balance sheet sitting on the cash. So that is not a problem at all for us. So point is to diversify our cargo profile and revenue, and this thing will not be an issue. As per the market prices, we will be able to charge this, and if we run it more efficiently, we are able to increase our revenues from what the current at prices it is being run. And secondly, one more berth will in future come from the Kolkata dock, which is likely to come very near. So we will be looking at those opportunities also, so that we have a good presence over there in the Kolkata port.
Can you explain to us this rationale of nearly 4,700 rupees per TEU as a royalty? How does that compare with all the other ports out there. What is the freight rate per TEU for you to be able to give that sort of royalty?
See, this all, in the beginning when we acquire anything, whether we acquired in JNPT and all that, everything in the beginning looks, that it is, royalties on the higher side. But if we run it efficiently and ramp up the capacities, so then, the numbers and efficiency and returns profile comes. On the face of it, if it comes, then everybody will bid for that. So that
what I'm trying to understand is how does this compare with royalty which is paid to other parts of the country?
No. So if you look at whether Tina Tukra or whatever has happened in Kandla or Mumbai, all were on much higher than this also. So that's not an issue. So issue is you must have a cargo visibility. So that we have a good sense of the cargo visibility in that region.
What is the visibility that you have? I mean, how many TEUs do you think you can move here?
No, we can do much better than the capacity also. That is, capacity is 450 by doing various optimization, by starting night operations, putting up a better cranes. So the cargo is no dirt there.
Okay.
So can you help us understand what we're trying to ask is that, say today if JSW Infra is doing X amount of volume, if you get this facility and by the time these two berths come up, it could be how much? X plus 20%, X plus. We're just trying to understand over what time frame.
They grow. If you look at JSW Infra, we have 9 terminals and we got 3 private ports. From 177 million tons, we are taking it to 400,000 tons.
Correct.
So in that scheme of things, as a percentage increase is not a very large percentage increase. But likewise, every year, some capacity will keep coming in and we plan to add it. So if you look at, say, 500,000 TEUs would be what, 7 million tons of, say, in terms of tonnage of the cargo, if you take, around 14 ton a TEU as a thumb rule. So, if I am already doing 117 million tons, so it is a 7 million ton. So,
got it.
The point is not that. Point is that every year such assets we keep acquiring and we make a full chain of these terminals, which gives us more, efficiency and EBITDAs and the revenues.
Can you give us a sense of what sort of revenue you are looking at on account of, this for FY26? Because you had earlier given a guidance of 720 crores in your logistics business with 15% margins.
See, these exact details we can talk during the Q1. By the time, hopefully, this will, whatever till official announcement comes, it will be too early to talk all these numbers and detailings. So we must get it first, which we have not yet got it. So this is, we can talk at the appropriate time.
Sure. Thank you, sir, for joining in. That's the word from JSW Infrastructure. Markets are flat. The Nifty is below 25,400, a minor cut of 23 points. HDFC Bank is in focus. That's the heavyweight, which reported the Q1 business update. Gaurav is here to revisit the numbers for us. Gaurav?
Well, yes, HDFC Bank came up with their Q1 updates, and it looks like good set of numbers is what the bank has reported. When we look at advances, they have increased almost by 6.7% on a year-on-year basis, while deposit growth has been strong at around 16% on a year-on-year basis, and it also implies a strong growth on a sequential basis as well. Deposit growth, let's not forget, this was driven by the term deposits, and as a result, when we look at the CASA ratio, and implied CASA ratio comes at around 33.9%, which is again in line with what the street is expecting. Now, let's not forget that bank had said that they will be bringing down their CD ratio in the range of 85 to 90% in a gradual way. And if we look at the advances and deposits in this quarter, the CD ratio comes at around 96%. That again shows that the bank is actually moving towards what they had guided earlier. Another key point to highlight is that they also had mentioned that they are going to grow their loan book in line with the system. Now, Q1 loan book growth is usually weak, and it seems that the bank is picking up at the pace of system, given that 6.7% growth on a year-on-year basis for Q1, and at the same time, average loan under management also grew at 8.3%. So definitely, good set of number is what we can see for now. We will be watchful on how the NIMs are going to be, but for now, good set of numbers from HDFC Bank.
Got that. Thank you very much for that. Let's invite the next corporate now on Bazaar, we've got BLS International. Joining in to talk about the quarter gone by, looking ahead, Shikhar Agarwal, Joint Managing Director at the company, is now with us on the show. Shikhar, thank you for joining in. This is Reema here. Now, the quarter gone by had multiple geopolitical flashpoints, whether it's the India-Pakistan or the tensions in Middle East. Flights were getting rerouted. Then you had that Air India, the fateful crash there. Was Q1 softer than expected on the back of these developments? Is it tracking lower than what you were earlier anticipating? And what was the impact on the whole?
See, if you see our last year numbers, we've done a 70% growth compared to last year. We did a 540 crores of PAT compared to around 300 crores last year. If you talk about Q1, these geopolitical risks keep on happening from the inception of the company. There was a war in the Middle East, etc. But we have not seen any impact on our numbers. The demand for tourism continues to be strong globally. There is short-term impact, but on a long-term basis, we have not seen any impact. So our numbers remain strong.
So there was a short-term impact, though, in Q1.
I mean, definitely, at the time of war, the stoppage of flights happen in some certain jurisdictions, but then it is also, compensated by increase in travel in other jurisdictions. So definitely on an overall basis, if you see, we have not seen any big impact.
Right. If you could give us a sense on the applications that you processed this quarter, what's your target for this year? And what proportion of those applications would be in the value-added space, or rather the premium space?
See, if you talk about last year, we processed around 4 million applications. It was a big growth compared to the year before. We also had consolidation of our acquisition opportunities like iData and Citizenship Invest. So 20% of the revenue even flew in from that. The first quarter numbers will be out soon. So definitely we will be sharing the numbers when the results are out.
This year, what are you targeting in terms of applications? 4 million last year. How much do you think can you do this year?
See, next 5 years now, what we have seen is, if you see the last 5-year trajectory, we have grown 70% CAGR. As the company, as the base becomes bigger, our objective is to maintain the EBITDA margins and the growth momentum. Our target is, if in the next 5 years, if we can do 25% plus growth year on year, I think we can really increase the size and the base of the company. So definitely that is the target, in terms of volume, in terms of revenue, etc.
You think 25% CAGR revenue growth over the next 5 years is possible without acquisitions on a pure organic basis?
See, definitely, if you see the opportunities that are throwing in the market, there are billions of dollars of contracts that are up for renewal. We as a company now have global market share of 17%. The industry is growing 14% annually. It is poised to become a $4 billion industry in the next 2 years. So definitely, if you see all these factors, new governments are outsourcing new services, new territories, etc. So our market share increasing, new governments outsourcing, we definitely feel that we can continue the growth trajectory.
Your market share globally is 17%. And what would be VFS's market share? And how has the market share changed in the last 5 years?
See, when we started, 10 years back, starting getting into the foreign government space, we had only the market share of 5 to 7%. Over the years, it has grown to 17%. Definitely, our competitors, which are backed by private equity, will have bigger market share. But what I know is our market share is around 17%, and we feel both the industry is growing, the outsourcing market is growing, and the visa volume is also growing. So our market share is also poised to grow in the next few years.
What we understand is that VFS or some of these operators might be looking at an IPO in the Indian market as well. Currently, the only play in this travel and visa space is BLS International. The scarcity premium goes away. So to that extent, for those who are looking at your numbers and then VFS's numbers, what is the your pitch to investors who would be looking at BLS then, saying because VFS obviously is a lot bigger?
I feel that this is a big advantage for us. More players getting listed in the Indian market is a testament for, we have been listed from 2017. We have been saying that the Indian market is really good. And I feel more industry data coming in, more players coming in, more research on the industry, more awareness about the industry will actually lead to a growth in the industry, growth in the visibility on the industry, growth in the market as a general, more investors coming into the industry. So definitely we feel it is a big benefit for us. Right now, we are the only listed player in this segment globally. So more companies getting listed will definitely add on, I feel, to our valuations, to our numbers, to the insight into the company.
And how many contracts of yours come up for renewal this year, and how many new markets are you looking to bid for this year?
See, most of our contracts in the last 2 years we have renewed. So 90% of our revenue is intact. We have a clear visibility of at least 5 to 7 years. But there are multiple contracts that are coming up for renewal of the competition. If you talk about billions of dollars of tenders are coming up for renewal, there are newer governments that are also considering outsourcing, first-time outsourcing. So definitely there's a big opportunity pie in front of us. Even if you see the acquisitions that we did last year, only some months of the revenue had come in. The full year revenue will start coming in from this year. So definitely there's a big leeway for us going forward. And these new players, the other players getting listed will add more visibility to the industry.
Any new white spaces you're targeting in your business housed under BLS International? One, of course, is to go deeper, wider in the existing visa business. New contracts are coming up. Many first-time governments are outsourcing their visa processing. But any new white spaces in the next 5 years that you're contemplating?
See, if you see the acquisitions that we did last year, we wanted to get into, long-term visa space. That is why we acquired this company, Citizenship Invest, which is working globally with multiple nationals, facilitating second passports, residencies, etc. So definitely that was more aligned to our government service business. Going forward, if there are businesses wherein there is government outsourcing globally, user pay model, negative working capital, etc., we will be very inclined to look at those businesses. But as of now, we see a big opportunity in the visa outsourcing space. So that is what we are focused on.
Right. And margins, you said you are looking to maintain. Are you looking at around 30% from here on? 25% revenue CAGR, you've given us the numbers. Margins, what is your aspiration?
See, if you see our margins have grown from 21% to 28% and now 34% in the visa business. So there has been a constant increase in margins. We've been doing efforts for the last 5 years. Now with the, increased base, we are a 540 crore profit company. Our immediate target is to maintain the margins even on the increased base. But overall, we are continuously focusing on technological efficiency, cost efficiency, increased revenue. So definitely our immediate and long-term target is to maintain the margins. And then if there's an increase in margin, it will be more long-term.
All right, we take that point. Thank you so much, Shikhar, for joining in. Always a pleasure speaking with you. In fact, we're done with this conversation, but not done with the travel and tourism space itself. Take a short break. On the other side, Rajiv Kale of Thomas Cook joins in to discuss the summer demand trends and their FY26 outlook as well. Stay with us. Even as the markets have flattened out, the broader markets have picked pace once again. So Bosch, for instance, has moved to the high point of trade. We are seeing some traction in IGL, Mahanagar Gas, or some of these city gas distributors doing well. And Godrej Properties too has moved to the high point of trade. So if you look at the advanced decline from what it was, say, about 20 minutes ago, we have seen an improvement, a marked improvement, with around 1,600 stocks advancing for 800 stocks, which are declining right now. That number was a lot lower just as we started trade. But let's talk about the travel and tourism space itself. The management of Thomas Cook India now joins in on what summer has been for them, but more importantly, how FY26 is panning out. Rajiv Kale, who's the president and country head, holidays and MICE visa services, a whole host of travel services that they provide, joins us now. Thanks a lot, Rajiv, for joining in. How has summer been? Let's start with that, because there was unseasonal rains. There were a lot of these, geopolitical issues. In domestic tourism itself, we had the India-Pakistan skirmish that happened. So to sum all of that together, how was summer 2025 so far?
Good morning. Thank you for having me. Summer 2025, I think we saw a little bit of a blip towards the end of the summer. I think what we look at is, our acquisition for Q2, which is April, May, and June, was fairly good from the acquisition point of view. So we didn't see a very big impact as such on this quarter. The acquisition was obviously slow for July, August, and September, which is the next quarter. But we are very confident that we have taken some aggressive steps to kind of restore the confidence of the travelers, the customer, to keep traveling, and we will get the demand back.
So what did Q1 report in terms of revenue growth according to you, and what's your outlook for this entire year?
So we look at the calendar year. So for us, the Q1 is basically the Jan, Feb, March, which was fantastic. We were ahead of the target. Q2 also is, looking good. We still have some, numbers to kind of conclude. So on the whole, this year is looking good, and we will be on our target or ahead of our target.
What is the target be?
So we are looking at growth of between 12 to 15%, and we should be there on that growth trajectory.
Can you give us a breakup of that growth as well between your several segments, travel, and there is corporate services. So this 15% growth that you're speaking about.
I'm talking about the travel business.
Only the travel business. Yeah. Okay, so within travel, can you give us a mix between domestic, outbound, long haul, short haul?
So largely we are, long haul and short haul where the growth comes from. Consolidatedly, I can talk about the number because we actually consolidate those numbers from long haul, short haul, domestic, and then we have corporate travel, and then we have MICE. So these are the three large units that we look at from the overall travel as a whole spectrum is concerned.
So all put together, you're saying everything put together should grow at
the leisure side. We are looking at the growth of 15%, 12 to 15%.
Okay. And corporate travel.
Corporate travel, very difficult to comment at this point of time from the year number point of view. So as the case with MICE, which is meetings, incentives, and conference, I think we will have to see how the demand comes in for the coming quarter, and but I think the pipeline is looking very good.
Okay, you've got a cash of more than 2,000 crore on your books. What's the plan? At least in the second half of the year, are you planning to deploy?
You talked about the cash.
Yes, cash on your books. What is the number now, and what are the plans with respect to deployment?
See, we have some plans as far as the expansion of business is concerned. We will look at the AI space is something which is very important, and we have already invested in that. And there are other growth plans are there, which we will talk about it to the market as it comes through.
All right, you're looking to invest in AI. Speaking about AI, you have the digital photo vertical, which has actually been an underperformer in the previous quarter. If you look at the numbers, there has been a decline in revenue. There has been a decline in profitability as well. At a time when everyone has a phone and
DIE is a completely different division, and I will have their managing director talking about that specifically. That is much better.
Rajiv, just to go back to that point on corporate travel and MICE, your meetings and corporate event segment.
Yeah.
You're saying it's looking good, but you're refraining from putting any sort of numbers to how much that business will grow. Is there a concern? I mean, corporates cutting back? Didn't quite get a clear picture on the corporate side. So and how much does it contribute? How much are you projecting leisure travel will be, and how much will corporate and MICE be?
So I'll talk about the corporate MICE because that is my area. I'm the head of MICE. Yeah. When I'm looking at MICE, if I have to compare it with last year, I'm very confident that we will have a growth of 12%. We are also heavily involved into the government business, which is the Sports Authority of India. We are impaneled on SAI. So we did a large event, in the first quarter, which was the National Games, which was held in Uttarakhand. And government is looking at expanding their portfolio from the Sports Authority of India point of view. There are various Khelo Indias and National Games are coming up. So that is definitely going to help us because when we are looking at MICE, we just don't look at the corporate. We have exhibitions, we have sports authorities, events.
What proportion of your revenue comes in from the government? What proportion of your revenue comes in from the government?
Approximately 10 to 15%.
All right, we take that point. Thank you so much for joining in and giving us an outlook. 12 to 15% growth in your travel services vertical is what you're guiding for this year, led by at least 12% growth in MICE, and you have the government, which accounts for about 10 to 15% of your sales. You believe that, with Sports Authority of India and some more events taking place, this year looks good. Notwithstanding the weakness that we've seen in the previous quarter, you believe that the forward bookings are strong. The street likes what you've said, and we've seen a bit of an uptick in the stock price from the time that you came. The street is betting on these themes. It's up around 4% for Thomas Cook. Let's welcome Mitesh Thakkar back on the show. Mitesh, your trade at 10, what would you have?
I think markets have reversed to slight negative for opening, and the 25,400 still hasn't been taken out decisively. So on the index, I'm waiting, in case we start going below that, we might get a 200-point kind of a decline. Else it will be a 200-point kind of range on the upside, 25,400 to about 25,650. On the stock side, Lupin is a buy for me. Buy here with a stop at about 1950. Look for targets of around 2025 to begin with, and then maybe even more. And the second stock is on the negative side, persistent system. I would want to sell if it starts breaking below 59.10, 59.15. So sell below 59.10 with a stop at about 59.60 and look for targets of around 5,800.
Just wanted an update on your 9-10 call on BSC, because the stocks opened sharply lower. Do you think it makes sense to stick on the long side for BSC or maybe stay away?
In fact, with the gap down Mangalam, there was no long position initiated because it opened below the, so nothing was initiated. Just that maybe a news flow which kind of negated the charts.
All right, take that point. Thank you so much for joining in, Mitesh. With that, we'll take a short break on the other side.
Before we take a break, we've got some fresh updates from the US president. So just point this out. So the most important point is he's saying that countries will start paying tariffs on the 1st of August. So it's not like 9th of July or 10th of July, suddenly these tariffs come into effect. But he's giving mixed signals. He's saying that the value of tariffs could range from anywhere from 10% going all the way to 70%.
Which is exactly why I did not allude to that even as I was reading this. Because, Donald Trump says countries will start paying it from 1st August. They will start sending tariff letters to countries starting Friday. Which countries? We don't know.
Correct.
How many letters? We don't know. What would be the... So, after reading this out as well, we'd be none the wiser until Donald Trump says something again. And even after that, we'll be none the wiser.
Sometimes you have to read between the lines, Mangalam. And if you read between the lines, then the sense is that there is still posturing going on. The sense is that negotiations are still underway. He's saying he'll start sending out letters to some countries over this weekend. But there's no immediate tariff levy from the 9th or the 10th of July. So I think this is still a little bit of, maybe brinksmanship, negotiating tactics, call it what you want. A little bit of that's still going on. That's the latest on tariffs from the US president. We'll come back on the other side and then turn our attention full throttle to the commodities market. Back in a moment.
Okay, then index should come up for you on your screen absolutely unchanged. We're talking about 0.00%. Individual stocks are flying around, but we'll get to that in a bit. For now, it's over to Manisha for the entire lowdown on the commodity markets. Manisha.
Thank you for that, Reema. I'm looking at iron ore prices. Within the metal sector, we have been seeing all of those metals actually continue to do well, ferrous and non-ferrous. But the iron ore prices clearly have been gaining for a second straight week. In this week, now we are up by 2%. For the year so far, we still are in the negative by 7%. One of the underperformers, really, when you look at metal as a sector. But three of the major top lines really come in from China in sense of support for iron ore. One is the industrial output capacity, where China is looking to reduce that. The other is about China supporting its struggling steel industry industry that could lead to more demand for iron ore going forward. And then China also is supporting its struggling steel industry, its housing industry as well. And the markets believe that China's stimulus could drive construction recovery to support iron ore prices going forward there. The other thing is about resolution by the way of tariff trade agreements that could also stabilize prices. The markets are looking at US making trade agreements with various countries, and that in turn has been supportive for metal demand, industrial demand, and in turn for metal prices there. The other thing also is about the shipments in sense of supplies. Australia, Brazil, we've seen shipments on a decline. These are the major producers of iron ore, and we've seen decline in the last couple of months on an FY25 basis as well, and that markets see as supportive. And then the major miners like Rio Tinto, BHP, Fortesque, Vale have reported lower exports on a month-on-month basis for the month of June. That's yet another factor which is leading support to the markets there. If you look at the Indian markets, then we're looking at better production. If you look at 2024 for the 2 months here, we're looking at 53 million tons versus 52.7. It's a 0.6% of a gain, but gain nonetheless. And when you look at the year-on-year production when it comes to iron ore, we saw record numbers for the FY 2025 at around 289 million tons, which was at around 277 million tons in the last year. The final plate shows you on what is the outlook for iron ore prices going forward, and most global banks and brokerages believe that you could be looking at a higher number going ahead. BMI and UBS talk about $100 a ton, and then you have ING, AOC talking about 80 to 95. Goldman Sachs also says $95 a ton is a possibility for the iron ore prices going ahead.
Okay, all right. Manisha, got it. Thank you very much for that. That's the latest from the commodity markets. But the latest in the equity market is that the Nifty is still struggling. It's down about 1% or so, absolutely flat. And trend is still down 7%. Mangalam?
Well, now from what we spoke about earlier to now, the only difference is that the company has officially updated the exchanges on the first quarter numbers. Yesterday, they said that it would be 20-ish% sort of growth in the first quarter in the annual general meeting to analysts, basis which the analysts came out with their notes. But now the number is on the exchanges. 20% is the exact revenue growth that the company has reported on a standalone basis, 5,061 crores. They've added one West Side store. They've added 11 Zudio stores in the first quarter. Remember, a large part of the Zudio store additions happened in the second half of the previous year. So the street believes that maybe, they will start catching up when it comes to same-store sales growth in the last part of this year as well as these stores anniversarize. But 35% is the CAGR that the company has reported over the last 5 years. 25%, just a couple of weeks ago, management said could be sustainable. And in that, a 20% growth is something that the street definitely did not like, especially after, a 30% rally from the lows on the stock itself. So on the back of which brokerages have cut their estimates basis the first quarter performance. FY26 revenue is being cut by 5% and FY27 by 6% by Nuvama. And as a result of which, they've cut their EBITDA estimates by about 9 to 12% too. And they've downgraded the stock from, buy to hold. And they've cut the target price from 6,600 rupees to 58.84, marginally above the current market price. But still, it's a hold.
And in this stock market or stock exchange update, they've not given any other reason. And I'm just trying to think if there could be an aberration, whether they have a lot of their stores. I'm not sure. I mean, for instance, in the western northern states, because of the skirmish. I'm just, completely talking out of my hat, but just trying to figure whether this could be an aberration quarter or whether this is
genuine concern. If it was, the company would have given it, but the update is largely, pretty fact-based, and that's why we're seeing the, reaction. Had it been any reason that the company would have given, etc., maybe the stock would have seen a recovery from the lows, etc. But in any case, your FY26 estimates now stand downgraded, whatever be the reason.
Mm-hmm. Indeed, thank you very much for that. Well, with that, it's time for a short break. On the other side is our special segment. It's the economy. Lata analyzes Credit Bureau CRIF's report on how India lends. With Sachin Seth, the author of the report, CRIF India and South Asia, and Madhusudan Ekambaram of Credit B Financial Services, Kanika Pasricha of Union Bank of India, and Sudipta Roy of L&T Finance.